Good morning, everybody. It is not the Live at 5, but it is Hugo Quintanilla. I am here. Good morning. I wanted to thank you guys for tuning in. If you just so happen to log on to Facebook and see me, I have a very special guest today that I wanted to introduce you with. One of my very close colleagues and coworkers, Eric Johnson, will be dropping in. And he works with Prosperity Home Mortgage. They are a lender nationwide that can work with you locally, has agents all over the United States, and really one of the most reputable companies in the area and in the industry. So I'm really excited to kind of give you guys a little different perspective into the mortgage and lending world, a little bit more human of a perspective, because I think we all started from somewhere. I didn't start as a real estate agent. I didn't come out the womb selling real estate. So I know Eric didn't come out, just doing mortgages as well. So he started somewhere. And the why for him getting into the industry, I always find very interesting. I have a lot of old classmates as well that have gotten into the industry. And why someone gets into lending is always fascinating to me. So let me stop kind of lollygagging a little bit. Let me bring Eric in and we will get started. So guys, please say hi to Eric Johnson for me. Eric, thank you so much for joining me this morning. I
Hey,
really
Hugo.
do appreciate it. Hey. And just to say a little bit about Eric, let me kind of put this on screen here as well. Eric is, like I mentioned earlier, with Prosperity Home Mortgage. Here is his contact information in case you guys want to see it. Go. Oh, let me get this back up here and share this here. There we go. This is Eric, and you can go ahead and find him online. He can apply, refinance, really help you out with questions. An amazing resource to talk with, and all his contact information here. We're going to be asking him a few questions today. He's a really busy guy, so I'm not trying to take a lot of his time, but top 1%. So keep that in mind. Hey guys, he works with Prosperity Mortgages. But Eric, just to kind of go back on your history in the lending industry, you've actually been in lending and in this industry for, I would say, almost more than 20 years, I saw?
Yep, I started in 2003. Didn't really have a clue what I was getting into, but it's turned out to be, one of the best decisions I ever made was switching from the industry that I was in, which is more kind of the leisure kind of side. I used to sell playgrounds and tennis courts. So I had to go from putting, fry boots on every morning to putting a suit and tie on, because back then, as you can see my profile picture, it was even with the suit and tie. We're a little more casual these days, but yeah, it's been over 20 years. Yeah.
It has. And you actually returned to Prosperity Mortgage in 2019, correct?
I did. Yes, I got my start at a company called BF Saul, which is part of Chevy Chase Bank, which is no longer around. And then I went in the in-house mode. I worked for a company called WCA and Miller, which is actually an affiliate of Long and Foster now, but at that time they were their own brokerage, and they had their own in-house mortgage consultant company. They had 5 offices in the Montgomery County area, and I held one of them. The market was about to change in 2006 and 7, and I saw the writing on the wall, so I went to a company called Prosperity Mortgage. At the time, we were owned by Long and Foster and by Wells Fargo. It was called a joint venture. After the iteration of the CPFB in 2010, joint ventures have really been phased out. The CPFB wasn't sure if it was as kosher as an arrangement as the pen to paper looked like. They really were. No one was ever getting incentivized to give business anywhere. But the whole Prosperity in-house kind of experiment started in 1999. So Prosperity Mortgage has been an in-house lender for Long and Foster for almost 25 years. So they've had different lenders behind them, but now they're their own freestanding mortgage company, right? So when joint venture was canceled between Wells Fargo and Prosperity formed their own mortgage company, right? So their own freestanding company. Cost a lot of money to do that, but they did that in 2013. So I left in 2012, the end of 2013, and thought maybe the grass was greener outside of being Prosperity. After 6 years, I realized it was not, and I ended up having an opportunity to come back to prosperity. It's been the second best decision I ever made. One was getting into lending, and the second was coming back to prosperity. We're a little different than every other lender. I sit right inside your realty office, right? So if there are challenges or issues with the file, I can't hide behind my voicemail or behind my email. I will have a line of realtors sitting outside my office, knocking on my door and saying, "Hey, what's up with this file? What's up with this loan?" So I feel I am more accountable than every other lender in the market that's a non-in-house lender, because I am accountable all the way up to the president of Long and Foster, so Jackie Teal. So that it holds me to account for the type of service that I provide, the type of tutelage that I provide to my clients, and making sure that we get things done on time every single time.
Not just to your clients, Eric, to us as well as agents, the amount of education, the amount of information that you've shared with my clients and myself, it's just been a wealth of information and knowledge. And really, I thank you. And speaking to the matter of how close and how directly you speak to upper management, I've met all your bosses. I've spoken with all your bosses. They're right there. They hear me. They look at my emails. They talk to me like they're people just like you and I. And I really one of the few companies that I've had the benefit of having such great interactions with. So really, thank you again for your time. I don't want to take too much of it. And let me just start off, asking you really kind of an easy sort of, starting question. What kind of going back to your history, what motivated you to get into lending and maybe even buy your first home?
Thanks. A great question. So as far as lending was concerned, a lot of the where my kids were going to school, went to a small Catholic school in Bethesda. A lot of the dads that I interacted with, I'm a lender, and they're all working for the same company. So when I decided to make that switch industry wise, it was an easy transition to go and talk with them, and I could do a lot of vetting with them before I actually, decided to make that switch. And it was easy. And the company I went with was really known for really good training. So if you're not a financial person, or you're not good with numbers, or you're not, don't know the mortgage industry, that was a great fit for me. But buying my first house, as you can see the snow on the roof, I've been around a while. And when I bought my first house, it was in 1996, right? So my wife and I, when we got married, we moved to my parents' basement for a year. So that rent was free. We tried to save our money, and then we were expecting our first child. So we rented an apartment for a year. And I believe the rent was like $1,700, which in 1994 or 5 was a lot of money, right? We were just starting out, and after the first year, we're like, well, why are we renting, right? We really want to have a home of our own. My wife was an interior designer at the time, so it made sense. You can't really make a lot of changes to a rental home, whether that's owned by a property management company or owned by a private landlord, right? If you make any changes to the house that you're in, you have to change it back before you move out. Well, that's not really pride of anything other than changing your current situation where you're currently living, right? So, hey, the walls are pink, I want them blue, or whatnot. But and I grew up in a single family house, so I wanted to have a yard with gardening and all. My deal with my wife when we bought our first house was she takes care of the inside and I take care of the outside. So we had a small backyard, and I took care of the landscaping and things like that. So it's a deal that's worked out really well for 30 plus years. So, but buying our first house, we ended up buying new construction. We looked at a couple of houses in different areas, and we lived in Germantown at the time. So it wasn't like we were tied to Germantown. We both grew up in lower Montgomery County. But as far as affordability and what we thought we could afford, we stayed in that Germantown area and ended up buying a new home. So as you know, most of the time, 99% of the time, they say, okay, here you're buying a new house, you're going to get X amount of money from the lender from the seller and the home builder if you use their lender. And that's what we did. I was 28 years old. I had no idea that there were other lenders out there, right? And as far as buying my house, wanting to buy, it was basically that pride of ownership. Along with, I think at the time, my parents were probably saying, the tax benefits as well with regards to mortgage interest and the deductibility as well.
Wow, that's really speaks to a lot to kind of my age group right now. A lot of people kind of sacrificing their first few years, rooming together, living together, trying to, make it so that they can get that down payment or save up. And the pride of ownership. Oh goodness, like, how many times have you wanted to change something in a rental and you just can't? It might be something hideous, but you just can't change it because it's not your property. And you were actually, wow, a new construction at 26. Do you still have that property?
No, that's one of the decisions that we decided to. We owned it for about just over 5 years. Wanted to get a larger house. We were expecting our second child, and we ended up selling it. I think we made $25,000 in 5 years of ownership. And back then, we're like, woohoo! We struck gold. We
Yeah.
made some money. Good deal. Looking back and how the housing market exploded in the early 2000s, for what we netted and what we kind of applied towards our next house for down payment, because we ended up moving out after we sold and moved in with my mother-in-law to help save money for that next house. So we hadn't found that next house. That was smart, right? Well, if we were really truly geniuses at 32, we should have saved it and rented it and kept it, because that same $210,000 house was over $500,000 5 years later, right? Well, so no one can predict these things, right? So
Correct.
looking back, we wish we still owned it, but it was still a good experience in buying and owning it.
Absolutely, absolutely. And I think it not only opened up your eyes to, the possibility, like now things were on your terms. You could choose to sell the property and then move in somewhere else. It wasn't like
Hmm.
you were forced to move it back in with your family. And
Right,
we
right,
saw that over COVID. A lot of people were forced to have to downsize
right,
and readjust. So it's okay. It's
right,
I, I don't think enough people talk about it being all right to reset, to take a few
right,
steps back and to recalibrate, get a good plan under your feet, and then go.
right.
Because why are you going to waste your time, and extra money? Like, we're not talking about dollars and cents, we're talking about thousands of dollars. So thank you so much for sharing that with me. Um, Through your journey in the lending process, what were the most important factors for you comparing the different mortgage options, and how did you prepare for the mortgage application process when you were getting started at what,
So
26?
so yeah, I was green. My parents were, they were boomers, so their iteration of owning a house was paying off a mortgage, right? So that's, you get a 30-year fix, you pay it until it's all paid off, and then you don't have a mortgage anymore. So I didn't really ask around to any other people, even my peers who were buying houses at the same time. Everyone just sort of got 30-year fixed mortgages. At that time, 30-year fixed mortgages were 9%. Right? And no one thought, oh my God, they're 9%. We're never going to be able to buy. We're never going to be able to afford to buy. But at
People
the
are freaking
same
out about eight
time,
right now. Yeah.
right, exactly. So, and that's why I think it's kind of jovial when people are freaking out about 7.5% and 8%, right? Because I lived through a 9% interest. I had it for 5 years. Now, as I morphed into this career several years later, I wish I had someone like myself talking to me from that lender to provide me different options. I told them I wanted a 30-year fix. They said, how long do you plan on living in the property? I said about 5 years, right? So back then, an adjustable rate mortgage would have saved me probably about $25,000 over 5 years had I gotten an adjustable rate mortgage instead of a fixed rate mortgage, right? Because
Wow.
we're fixing that rate for 30 years. That's assuming I'm going to own and live in that property for 30 years.
Yeah, the whole time.
That would be right now, right? I'd still own it and I'd still be living in it and the mortgage will be paid off, right? I lived in it for 5 years. So I didn't need to secure that mortgage for a full 30 years, right? So had I had a conversation with that mortgage lender to say, look at a 5-year ARM or a 7-year ARM, I probably would have gone from a 9% to about a 5 or 6% interest rate, because the spread back then was much larger than it is right now. Right now, the inverted yield curve is causing arms to be higher than 30-year fixed rates right now. So most people are getting 30-year fixed. But that's I look back now, I'm like, gosh, I wish, right? I wish I'd had that conversation. So for people moving forward, always ask those questions. When arm rates used to be lower up until about 2012, I always ask that question. Let's look at the difference in what you could save over 5 years or 7 years and what you could put that money to. You could pay down the principal faster. You could put it towards, saving for renovations or college education and things like that for your kids, or whatever that looks like. Don't spend extra just for that security of a 30-year mortgage, right? So before 2019 happened, The average length of time that everybody in the United States stayed in a mortgage was 7 years.
Oh, wow.
Was 7 years. Why? Well, people move, housing needs change, um, people pay off the mortgage, and interest rates change. So if interest rates change every 6 months to a year, and you can see a benefit to refinancing and get a lower monthly payment every time, why would you secure that rate over 30 years? Now, right now, moving forward, that's pretty much the only option because the spread is so different, right? So why would I get a 30-year fixed at 7% if the 7-year ARM was 6.8? That's not an advantage. So but that's what I wish I had that process. I wish I knew what I know now when I was buying my first house, right? Obviously.
Yeah.
But that was the big one. And then as far as the process was concerned, we went in and met with the mortgage consultant. We signed a lot of paper in hand. It's filled out a verbal application. There was nothing digital about it. Now it's a completely digital process, right? We turned over, paper W-2s and pay stubs and things like that. I had no idea what a debt to income ratio was, so I was in commission. My wife was a salaried person at the same time. We just knew that we probably had enough income to be able to afford this and get approved. We had no idea what that looked like.
Wow. And you were really, really green, it sounds like.
Yeah.
Yeah. Oh my goodness. And it's really like 2020 hindsight, kind of you look back on that time now, especially all that you've learned. Same deal with me and real estate. My parents have been in real estate for a long time. I didn't realize how much my parents had suffered in their real estate journey until I became a realtor, and I realized how much they had to go through before fair housing and equal opportunity was a commonplace thing and a commonplace practice. So, guys, just to remind you, this is Eric Johnson with Prosperity Home Mortgage. In case you're just tuning in, he is one of my very dear colleagues at the office. He can help you with lending questions, mortgages, really refinancing, anything that has to do with financing. His QR code is up there. That's his direct link for his website. You can check him out online and connect with him, get his contact information as well. We're just having a small little chat about kind of, what it was like getting into the mortgage industry for him, and also what it was like for buying, his first house, from going from a regular person, like you said, commission sales, I think you said, all the way up to now being in the industry for over 20 years. Eric, it's I can't tell you how frustrating it can get when you have a lot of young people that want the dream of home ownership, and sometimes they can't really put one foot in front of the other to make those steps, and to get on the road to either budget, save, or start getting into that down payment mindset. You now having a mortgage, what are some kind of lifestyle changes or your financial situation? How has having the obligation of a mortgage changed and balanced your personal and professional goals?
Well, I would say, obviously, there's a progression, right? So I talked about living with in my parents' basement for free, right? So we tried to save as much as we could. Should my parents have charged me $500 of rent just to give it back to us when we moved out? Yeah, sure. But we were only there for a short period of time. Our rent was like $1,700, and then when we got our first mortgage, I think it was like $2,200 or $2,300. Like, oh my gosh, this is a stretch. This is an additional $500. We had a little baby. Babies are expensive, even back 29 years ago. So, yeah. So when you think about that, you're like, okay, it's almost like the carrot. Is it the carrot or the stick, right? So moving forward, we want to reach for that carrot. Motivated me harder in the job that I was in, and eventually motivated my wife to buy the business that she was working in, right? So
Oh, wow.
she was in her early 30s, and the woman that she was doing the interior design business with decided to retire. So she decided to buy that business, and it was a great decision, right? But again, moving that case, the carrot or the stick, is it motivating you to do more? Do I need to get a second job? Do I need to sit down and analyze my bank statements and see how many times I'm eating out, how many times I'm going for coffee, how many times I'm using discretionary income for things that I either don't need, the quick high, or just because, for lack of a better word, I'm a little bit lazy, right? So I find that people in the the 25 to 35 range when they sit down with, I have a really good friend who's a financial analyst and money guy. And he says the first thing he does, he says, send me your bank statements. I'm going to analyze it. And he puts it into a computer. And when you see that Starbucks number go up to, 100 or 200 or even $500 a month, that's a third of a mortgage payment, right? So
Correct.
for myself, it was more self-discipline. Hey, we didn't go out a lot, but you had to, tighten the screws, and then you get used to that mortgage payment. And then when you sell that house, the next mortgage payment was $3,200, right? So then what do? Okay, she owns her own business. I own my own business technically. So we just motivate ourselves that way. But you have to make decisions on what you're buying, right? And I think nowadays, Starbucks came into vogue when our kids were little, and I complained about the $3 frappuccinos or whatever they were getting back then, right? And not to pick on Starbucks, they were kind of the first in the area for that. Now, so that generation thought nothing of it in high school and college, and now after college to spend $6, $7, $8 a pop for a cup of coffee, basically, right?
Sugar water.
Exactly. So that's ridiculous. Now my kids are coming to the, they're in their late 20s, and like, they don't spend money on that stuff. They decide what they want to spend their money on. But that's the first step for people that are struggling, is let's analyze it. If you don't want to go to the financial analyst, I'm happy to review to review the bank statement. Or if it's a credit issue, hey, we've just been challenged in our credit. Life happens, right? And not everybody has stellar credit their entire adult life, right? So let's look at some of the challenges as to what made it happen and try to avoid that. And then I actually work with a credit expert who can review some of the items that are maybe above my pay grade, maybe removing derogatory information and things like that. And they get paid to do that, because if you try to remove old derogatory information on your credit report, it's a 24/7 job, right? And you have a real job. So you don't want to take time. So it's worth the few dollars that you spend to that analyst to review it, to put people on the path to homeownership. So there's so many people that deserve to be on that path of homeownership. But it's not so much just pride of ownership. It's pride of being a neighbor, doing things within and around the community, not having to worry about moving every year to 2 years, right? So if you have a landlord, what if they say they want to sell the house now? Oh no, now I either have to look for another rental, or I have to, scramble, right? Or take a step back, like you said. So those are some of the things that we love helping people with.
I love it. And usually it's not with any notice. Usually it's within 90 days, or if you're lucky, you get 90 days, but sometimes you got to be out of there. And then,
Right.
then what do you do? Especially in this market where there's such low inventory, we've seen the cases where people have just been put out.
Right.
Hey, we need to sell the house,
Right.
or the house is sold with them inside. Can you
Right.
believe that?
Exactly. Yeah.
What were some of the challenges and difficulties faced during the mortgage process, and how did you overcome those and seek help?
I think the biggest challenge for us as first-time home buyers at the time was coming up for the cash needed to close. I don't think we put 20% down, and that's the biggest misnomer now, even 30 years later, is that people think they still need 20% down to be approved for a mortgage. In the state of Maryland, there have been, I wish they were around when I was buying, but they have some of the best programs out there where you can get anywhere from 3% of the purchase price all the way up to $25,000 in down payment and closing cost assistance. So for me, as a first-time home buyer, and they crunched the numbers, I didn't know what closing costs were. So I knew I had X amount for down payment. So we ended up having to get it, not having, my parents offered to give us a small gift, right? So who hasn't been there where, hey, you're getting out of our house, make sure you don't come back. Here's some money to make sure you don't come back. So we were lucky enough that our parents were willing to gift us some money to make the challenge of the down payment and the closing costs make it work. I think at the time we put 10% down on a $200,000 purchase, something like that. So, so it wasn't a ton of money, but still back then it felt like a ton of money.
Oh, absolutely. $20,000 is $20,000, how are you satisfied with the terms and conditions, and what are some of the benefits and drawbacks of having a mortgage? I know that you talked about the different, an ARM versus a 30-year. With what you ended up having, how pleased are you with the whole experience now?
So looking back, I think we were okay because I didn't really know much about the process. So, looking back with the hindsight, I wish. But at the time, I wouldn't say we struggled every month or all the time to make our mortgage payment. That first couple of months, it was probably a big jump, right? The challenges I think we had was, as the house appreciated, I think we ended up getting a home equity line of credit, and we kind of used that as a revolving account. But the major benefits that we saw was every year when we did our tax return, right? So not only at the time I was commissioned, so I was technically self-employed, so I could have some write-offs for my taxes, for my expenses, and things like that. So did my wife. But at the end of the year when we did our taxes, we're like, okay, we got usually a nice healthy tax return at the time, which was then we could either pay off a chunk of mortgage, pay off a chunk of bills, because invariably, funny enough, when you buy your first house, you may not have a lot of debt, but once you get into the house, all of a sudden you have a Home Depot credit card, a Lowe's credit card. You get all the welcome to the neighborhood things for the people that search the land records for, types of credit and things like that. And we're like, hey, I didn't have all this debt when I bought the house. What's going on now? And it's just the natural evolution. You buy a house, it's brand new, you want to paint it. Got to go buy paint. Hey, take advantage of the Home Depot credit card thing. Next thing you know, you've got a Home Depot credit card with $3,000 on it. I don't remember how this got so high. So that's the biggest challenge as a homeowner, making sure you're still in charge of your monthly obligations outside of your mortgage payment.
I love that. And that just speaks back to kind of budgeting. And one of the toughest things in this market right now is just to find the money and delegate it, give purpose to your dollars and cents and make
Right.
them go further.
Right.
Eric, you've been phenomenal. I have one last question for you. What are some best practices or tips you've learned from your mortgage experience? And what are some common myths or misconceptions about mortgage that you encountered or debunked?
So I'd say best practices. If you're not sure you can afford a mortgage, pick up the phone and have a conversation. Whether that's with you, and then you refer them to me. It doesn't cost anything to crunch the numbers, right? Let's just have a conversation. Let's crunch the numbers, right? So the fear of not doing it and the ramifications of not doing it could far outweigh the fear of having that conversation. Well, I really don't want to have that conversation. My credit isn't in as good a position as I think it needs to be in. Well, let's have the conversation and find out, A, what you think your credit is, and let's talk about those challenges. And B, you don't have to have stellar credit to get a mortgage payment. That's what the entire FHA mortgage program, sponsored by the government, was put into place many decades ago, right? So we have mortgage programs that go down to 580 credit, right? Now, can you qualify for first-time buyer programs and 580 credit? Probably not, right? So those are different challenges that we need to work through. Secondly, as far as kind of like myths and things like that, mortgage insurance is not a bad thing if you put less than 20% down. You can buy a $325,000 house in Montgomery County with zero money. Right.
Oh, wow.
So that's a huge one, right? Using the down payment assistance program through the Montgomery County program and the Maryland mortgage program. But I think a lot of people, a lot of millennials are like, well, I haven't been on the job for 2 years. You don't have to be on the job for 2 years. If you're employed, we'll take a look at your job history. We run it through the system. And if the system kicks back, hey, haven't been on the job long enough, then we'll let them tell us, right? There's no 2-year history. There's no 2 years on that same job that rules you out unless you're working 2 jobs, right? So if you're working 2 jobs and you want to count both the incomes, then you need to work both those consecutively for the 2 years. So that's the kind of things that I've been doing this long enough now that you guys think it's a big roadblock, where I say it's more of like a speed bump, and let's talk about it, have a conversation, and work through them. Because I think everybody who wants to own a home should deserve to own a home. Not everybody's responsible enough to own a home, but let's at least give everybody the opportunity to look at what that looks like, to see if they're able to. And maybe you don't start out with the $500,000, townhouse in Rockville. Maybe you start out with a $200,000 condo in Germantown. Like I started out with my first house, a $200,000 townhouse in Germantown. Ended up down county over the years as my income changed and my and our needs changed. But keep in mind, when people were on the sideline in 1979 because interest rates were too high, they said, I'm going to wait until mortgage rates go down. They would have had to wait 23 years for mortgage rates to go down from 1974 to 1990X, right? So that's a long time to wait for mortgage rates to go down before you enter into the home ownership. So let's take a bite, see what that looks like, see what it tastes like, and see if homeownership can be attainable for you, because everybody, like I said, everyone deserves that chance.
Man, I love the way that you put that there. It's not an obstacle. It's not a wall. It's not a barrier. They're speed bumps. They can be
Right.
traversed, and very
Right.
slowly you can go over them. And
Right.
sometimes they look a lot taller than they actually are.
Right.
Eric, thank you so much for your time. Really, really insightful. And I appreciate the personal approach that you've taken with this interview. And really, I thank you again for your time and just discussing all this stuff. Can you do me a favor and please let the crowd know where they can find you online, the best way to get in contact with you, your phone number, and just your socials?
Sure thing. Absolutely. Eric Johnson, Prosperity Home Mortgage. My cell, it's my only phone. I don't have an office line. It's 240-938-0559. My website is epjmortgages.com, right? It's real quick and simple and easy. My email is eric.johnson@phmloans.com. It was great talking with you today, Hugo. I hope this can benefit your clients moving forward.
Thank you so much. I'm sure it will. And we really hope to have you here again next time. So thank you again, Eric. Take care.
Cheers.
Guys, thank you so much. Take care. And we will see you guys soon. Have a great day, everybody. Bye-bye.